Right, lads and ladies, let's get into it. Today we're looking at indexes and the correlation between indexes and currency pairs or commodities or whatever asset you may be trading. So when we're talking about indexes, we're looking at one main index is the DXY, the Dixie, also known as the dollar index. What is it? The Dixie index, also known as the US dollar index, measures the value of the US dollar against a basket of 6 major world currencies. The index provides an indication of how the US dollar is performing in relative to the other currencies. And the 6 currencies in the Dixie are the euro, which makes up nearly 60%, 57 over 57%, the Japanese yen, the Great British pound, the Canadian dollar, Swedish krona, and the Swiss franc. Now, I'll leave this, this is part of the course. I'll leave the link for it down below. We're going to run through how it looks and how we can use it in the charts. But if you want to look through and get a deeper understanding of it, run through this yourself. But now, here's a little cheat sheet of correlated assets. If you want to take a little screenshot of that or take some notes of it, you'll see that the correlation just means what the two have in common. So, for example, you have the Euro USD and GBP USD. The correlating asset is the dollar, because both of them are traded with the quote currency as the dollar. Euro JPY and GBP JPY. Why are they correlated? Because both currency pairs use the JP and the Japanese yen. Same with CAD, same with whatever it may be. When we look at commodities, you have gold, it's XAU USD, which USD is your quote currency, and then we have silver, which is XAG USD. USD is the correlation between the two. So they're both going to move in tandem with each other. Relatively, they're not going to move the exact same way because silver is not gold and gold is not silver. And then you have your indexes and your cryptos and whatever have you. This here is very important to understand. And once you do understand it, it's going to give you a greater understanding of when you're looking at a chart, what's actually going on. So DXY is a great starting point for analysis for USD pairs. When you pull up your chart to do your top-down analysis or your market outlook of a Sunday, whatever you're doing, it's always a good gauge to look at the DXY first. Why? Because the currencies that you trade, currency that I trade, are linked to the Dixie. Why? Because it's the world reserve currency. Therefore, it's the most volume in assets that are paired with the dollar. Now, if we have a bullish DXY, that means any pairs that end in USD are going to be bearish. Why? Because if we have the dollar is gaining strength, that means whatever currency pair the dollar is linked with, if the dollar is the quote currency, it's going to be losing strength. So the chart is going to be going down. We'll have a better look at it now in a minute, and when we get to the charts and give you a visual and help you understand it more. But if USD is the base currency and the dollar index is bullish, well, then that means that the chart that you're looking at, whether it be USD JPY, is going to be bullish. And then in the bearish scenario, if we have a bearish dollar index or bearish Dixie, that means anything with the base currency that isn't the dollar, or anything with the quote currency that is the dollar, is going to be bullish. Why? Because if the Dixie is losing strength, it means any currency that's tied to the Dixie as the base currency is gaining strength in comparison relative to the dollar. And then the same again with a bearish scenario. It might sound a bit confusing, but we're going to jump into the charts there now and get a greater understanding of it. So if we jump to the Dixie, start out with the Dixie. If it loads, close some of these tabs. Now, jump to 4 hour. Right here, for example, this is the dollar index. So we can see with the dollar index from Friday the 16th of January to Tuesday the 27th of January, that we've been bearish on the Dixie, bearish on the dollar. So if we look at a currency like Euro USD, we're the quote currency. So remember, we have our base and we have our quote currencies. So your base currency is your first currency here. Your base currency is your euro, and your quote currency is your dollar. So if the euro is getting stronger, I'm just going to pull up clear data feed here. Bang. Pepperstone. Have we got anything with Pepperstone? No. Right. So we have our base currency and we have a quote currency. So our base currency is the euro. So it's going to be one base currency to whatever the quote currency is down here. So if the euro is gaining strength against the dollar, it means your chart is going to be going up like this. So if the euro is gaining strength against the dollar, well, then that means that the dollar is losing strength relative to the euro. All right. So if the dollar was getting stronger, then the chart would be going down because the euro will be getting weaker against the dollar. So if the chart is going down, it means your quote currency is getting stronger against your base currency. And if your chart is going up, it means your base currency is getting stronger against your quote currency. Now, so if we look at that same time zone, I think it was, we'll see now here, 16th, Friday the 16th of January, into the top 27th, was it? Yeah, the 27th of January. We can see that while the Dixie was going down, the dollar was going up. So we have a little look again. While the Dixie was going down, the dollar was going. While the Dixie was going down, the euro was going up. Why? Because if the Dixie is losing strength, if the dollar is losing strength, well, then that means that the euro is gaining strength in relative to the dollar. So if we look at another pair that's tied to the dollar, we look at GU, same thing again. Why? Because the quote currency is a dollar. So if the quote currency is getting weaker, well, then that means we're going to have a bullish chart. Why? Because your base currency is getting stronger against your quote currency. So if the chart is going up, just to clarify, the chart is going up, it means that your base currency is stronger against your quote currency. In this terms, it's the pound is stronger against the dollar. And if your chart is going down, that means that your dollar, your quote currency is getting stronger against your base currency. So if we look at a pair now, both of these pairs are correlated because both of them have the, both of them have the dollar as their quote currency. So for both of these pairs, when the dollar weakens, the chart is going to go up, and when the dollar strengthens, the chart is going to go down. So let's just look at a scenario now where the dollar strengthens, and we'll try find a good example. These are all good examples here and here, but I want to just find a clean example for you. And slow technology. Right, let's say from the 15th of September to the 24th of November. So from the 15th of September to the 24th of November, we can clearly see that the dollar was bullish. All right, so if we know that the dollar was bullish, what can we expect? We know the dollar is strong. What can we expect EU and GU to look like from that same period of time, from the 16th of September until around about 24th of November? It's a long period of time, but it's just to get you understanding it. So if we have a strong dollar, that means that any currency pairs that have the dollar as their quote, it's going to go down. Why? Because their base currency, the euro, is going to be losing strength against the dollar. So what day do we? 16th of September. Let's jump to Euro USD Pepperstone. Euro USD Pepperstone. Doesn't make a difference. What do we say? 15th of September. In around there. So now you can clearly see that from when the dollar index is getting stronger, well, then that means that the euro is getting weaker against the dollar. So then you have the chart that's going to be bearish. Why? Just to clarify again, drill this into your heads. Make sure you're taking notes because it's very important to be able to read and understand this. If our chart looks like this, well, then that means that the euro is gaining strength relative to the dollar. And if our chart looks like this, it means that the dollar is gaining strength relative to the euro. And then it's going to be the same again for GU. Why? Because they both have the same correlation. So if we look at GU for the same time zone, 15th of September. September around here. October, September. Back here. So there you go, clear example. When the dollar is gaining strength, that means pairs that are tied to the dollar are going to lose strength. So if we look now, that was where our dollar is our quote currency. So if we look at a pair now, we go back to our Dixie and we look for another example. Let's say for this same period of time, from earlier, a couple of weeks ago, 16th of January, we have the dollar index is losing strength, right? So the dollar index is losing strength. So if we look at an index where, a currency pair where the dollar is the base currency, so an index, a currency pair like USD JPY, what do we think is going to happen? If the base currency is the dollar and we know the dollar is going down, what do we think is going to happen? We would estimate, or we would think that the dollar, or that pairs like the USD JPY are going to also go down. Why? Because it's no longer Euro USD, it's no longer the euro against the quote currency as a dollar. Now the dollar is your base currency. So if we look at a pair like USD JPY, bingo, same thing happens. You have your base currency is losing value, which means your quote currency is gaining strength in terms, in relative terms against the dollar. So if the chart is going up, in this case, if the chart is going up, then that means that the dollar is gaining strength against the Japanese yen. And if the chart is going down, that means that the yen is gaining strength against the dollar. It's important that you understand that when one gains strength, one has to lose strength. One's always going to be weaker and one's always going to be stronger than the other. So it's not going to be me saying that the dollar is stronger against the yen. It's the same thing me saying that the yen is weaker against the dollar. It's the exact same thing. Or me saying in this scenario that the yen is stronger against the dollar. It's the same thing if I say that the dollar is weaker against the yen. It's just a different way of wording it. But some people get very confused with that. So if we look at another USD pair, now that's the only USD pair that I trade as the base currency. But we'll find one together. USD CAD. So if we know that the dollar index is going down, anything with the base currency as our dollar is also going to go down. Here's another prime example. You pull up a different example. USD chef. USD franc, same thing. It repeats, but it's important to understand because you'll be able to find discrepancies then. Because if we see that the Dixie is, excuse me, we see that the Dixie is losing strength here. Right, well, if the Dixie is bearish here, but then that means that anything with the Dixie as their with the dollar as their quote currency is going to be bullish. Why? Because if this is losing pressure, then that means that anything that's Euro USD, if we know that the Dixie is going down, but then that means that the euro is getting stronger against the dollar, and the euro is going to drive the price up. Same with gold, has the same correlation with gold, pretty much. Drop here on gold. Excuse me. Yeah, same with gold. It works across the board, really. However, it doesn't work as clear with indexes. Why? Because indexes aren't measured. It's not one share the index. It's just measured in that currency. It's not directly linked to that currency. You're not trading one share of the S&P against one share. Against $1. The dollar is just the currency that we use to quote what one share is worth of the S&P or the Nasdaq or the Dow or the whatever have you. But I'll pull back up this cheat sheet here now. Oh, if I have it, do I have it? Yeah. If you want to take these notes, it's very, very important. And because when you jump onto a chart, then you'll understand it a million times better. But that's it for indexes and the correlation between two assets. Make sure you understand it because you'll be able to find discrepancies then between two assets. For example, if you think, if you're looking for a sell on GBP USD, but you're looking for a buy in Euro USD, look at the dollar index, look at the Dixie, see what that's doing and see what bias that supports more. And you always, that's kind of just another confluence or confirmation that you can use to support your trades. So that's correlation and indexes, and we'll get on to the next video.